We're live from New Delhi, watching DD India News, India's voice to the world. I'm Lipakshi Khurana. Coming up in the next hour. US imposes new higher reciprocal rates from today. China faces a staggering 104% additional levy. Markets remain in turmoil. S&P 500 hits lowest close in almost a year. Donald Trump continues to defend tariffs, claiming they are already bringing $2 billion a day, stresses that the US is working on tailored deals with foreign trade partners.
Taking in almost $2 billion a day in tariffs, $2 billion a day, and we're doing very well.
Dominican Republican nightclub roof collapse kills at least 98, including governor and ex-MLB players. Rescue operations underway, cause of accident being investigated. President Draupadi Murmu arrives in Slovakia in second leg of two-nation-state visit to meet her Slovak counterpart Peter Pellegrini, hold delegation-level talks and exchange MOUs. And now let's go live across to Mumbai for Reserve Bank of India's Governor Sanjay Malhotra's Monetary Policy Committee statement.
The year has begun on an anxious note for the global economy. Some of the concerns of the trade frictions are coming true, unsettling the global community. We at the Reserve Bank, while remaining alert to these global developments, began the year celebrating the completion of 90 years of this august institution since its inception way back on 1st April 1935. The Reserve Bank's journey over the last 9 decades is closely intertwined with the nation's development and progress. As a custodian of monetary and financial stability, the Reserve Bank has evolved itself over the years into a full-service central bank with varied functions facilitating a market economy. Indeed, a very, very long journey full of accomplishments and achievements, something which every RBI is proud of, and something I believe the whole of India and its citizens are also proud of. In this challenging global environment, the Monetary Policy Committee met on the 7th, 8th, and 9th of April today to deliberate and decide on the policy repo rate. The global economic outlook is fast changing. The recent trade tariff-related measures have exacerbated uncertainties, clouding the economic outlook across regions, posing new headwinds for global growth and inflation. Amidst this turbulence, the US dollar has weakened appreciably, bond yields have softened significantly, equity markets are correcting, and crude oil prices have fallen to their lowest in over 3 years. In fact, as we speak, it is about $60 to a barrel. Under these circumstances, central banks are navigating cautiously with signs of policy divergence across jurisdictions, each reflecting their own domestic priorities. The Indian economy has made steady progress towards the goals of price stability and sustained growth. On the inflation front, while the sharper than expected decline in food inflation has given us comfort and confidence, we remain vigilant to the possible risks from global uncertainties and weather disruptions. Growth is improving after a weak performance in the first half of the last financial year, 24-25, although it still remains lower than what we aspire for. And now I come to the decisions of the Monetary Policy Committee. After a detailed assessment of the evolving macroeconomic and financial conditions and outlook, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 6% with immediate effect. I repeat, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 6% with immediate effect. Consequently, the standing deposit facility, the SDF rate under the liquidity adjustment facility shall stand adjusted to 5.75%, and the marginal standing facility rate or the MSF rate and the bank rate shall stand adjusted to 6.25%. I shall now briefly set out the rationale for the decisions of the Monetary Policy Committee. The Monetary Policy Committee noted that the inflation is currently below the target. It is supported by a sharp fall in food inflation. Moreover, there is a decisive improvement in the inflation outlook. As per projections, there is now a greater confidence of a durable alignment of headline inflation with the target of 4% over a 12-month horizon. On the other hand, impeded by a challenging global environment, growth is still on a recovery path after an underwhelming performance in the first half of 24-25, which is the last fiscal. In such challenging global economic conditions, the benign inflation outlook and the moderate growth demand that the MPC continues to support growth. Accordingly, the MPC unanimously voted to reduce the policy repo rate by 25 basis points to 6%. Moreover, it also decided to change the stance from neutral to accommodative. It also noted that the rapidly evolving situation requires continuous monitoring and assessment of the economic outlook. Let me now dwell a little on the monetary policy stance. This has been a subject of interest for some commentators and market participants. There have been questions as to whether it means a change on the policy rate or whether it signifies our stance on the interest rate or whether it relates to liquidity conditions. From a cross-country perspective, monetary policy stance is typically characterized as accommodative, neutral, or tightening. While an accommodative stance entails easy monetary policy that is geared towards stimulating the economy through softer interest rates, tightening refers to contractionary monetary policy, whereby interest rates are hiked to restrain spending and curb economic activity, all with the objective of reining in inflation. A neutral stance is typically associated with a state of economy which neither calls for stimulating economic activity nor calls for controlling inflation by curtailing demand. Therefore, it provides the flexibility to the central bank and the MPC to move in either direction on the basis of the evolving economic conditions. In our context, the stance of monetary policy signals the intended direction of the policy rates going forward. Accordingly, with respect to the policy rate, which is the mandate of the MPC, today's change in stance from neutral to accommodative means that going forward, absent any shocks, the MPC is considering only two options, that is status quo or a rate cut. Let me also clarify that the stance should not be directly associated with liquidity conditions. While liquidity management is important for monetary policy, including decisions related to policy rate, it is an operating tool with the RBI for various purposes, including monetary policy transmission. Monetary policy Decisions to change policy rates do, however, have implications for liquidity management, being the operational tool to carry out the policy changes. To summarize, our stance provides policy rate guidance without any direct guidance on liquidity management. I will, of course, be discussing later our approach to management of liquidity. Before now I share our outlook and assessment of the growth and inflation, I think a few words on the implication of the recent global trade and related policy uncertainties are in order. Let me first highlight the possible implications for growth. First and foremost, uncertainty in itself dampens growth by affecting investment and spending decisions both of businesses and households. Second, the dent on global growth due to trade frictions will also impede domestic growth. Third, higher tariffs shall have a negative impact on net exports. There are, however, I may say, several known unknowns. The impact of relative tariffs, our relative tariffs vis-a-vis some of the other countries are quite low. Then there is the unknown of the elasticities of our export and import demand and the policy measures adopted by us. You are all aware that India is very vigorously and proactively engaging with the US administration on the foreign trade agreement. These are just to name a few. These make the quantification of the adverse impact on growth difficult. The risks to inflation, on the other hand, are two-sided. On the upside, uncertainties may lead to a possible currency pressure and therefore imported inflation. On the downside, slowdown in global growth could entail further softening in commodity and crude oil prices, putting downward pressure on inflation. Overall, while global trade and policy uncertainties shall impede growth, its impact on domestic inflation, while requiring us to be vigilant, is not expected to be of high concern. Coming now to our growth outlook. Real GDP, as you are all aware, this year, as per the MOSPI figures, is expected to grow at 6.5%. This is on top of a 9.2% growth rate observed in the previous year, which is 24-25. In 25-26, the current year, prospects of agriculture sector remain bright on the back of healthy reservoir levels and robust crop production. Manufacturing activity is showing signs of revival, with business expectations remaining robust, while services sector activity continues to be resilient. On the demand side, bright prospects of the agriculture sector bode well for rural demand, which continues to be healthy, while urban consumption is gradually picking up with an uptick in discretionary spending. Investment activity has gained traction and is expected to improve further on the back of sustained higher capacity utilization, government's continued thrust on infrastructure spending, healthy balance sheets of banks as well as the corporates, along with the easing of financial conditions. Merchandise exports will be weighed down by global uncertainties, as mentioned earlier, while services exports are expected to remain resilient. Headwinds from global trade disruptions continue to pose downward risks. Taking all these factors into consideration, real GDP is now projected for this fiscal 25-26 at 6.5%, with Q1 at 6.5%, Q2 at 6.7%, Q3 at 6.6%, and Q4 at 6.3%. While the risks are evenly balanced around these baseline projections, uncertainties remain high in the wake of recent spike in global volatility. You would have noted that the growth projection for the current year has been marked down by 20 basis points relative to our earlier assessment of 6.7% in the February policy. This downward revision essentially reflects the impact of global trade and policy uncertainties, which I had highlighted a little while ago. Coming to inflation, the headline inflation moderated during January-February 2025 following a sharp correction in food inflation. The outlook for food inflation has turned decisively positive. The uncertainties regarding rabi crops have abated considerably, and the second advance estimates point to a record wheat production and higher production of key pulses over that last year. Along with robust Kharif arrivals, this is expected to set the stage for a durable softening of food prices. Sharp decline in inflation expectations in our latest survey for 3 months and 1 year ahead would also help anchor inflation expectations going forward. Furthermore, the fall in crude oil prices augurs well for the inflation outlook. Concerns on lingering global market uncertainties and recurrence of adverse weather-related supply disruptions, however, pose upside risks to the inflation trajectory. However, I may add that as per the latest forecast by various organizations, national and international, including our own Indian Meteorological Department, the monsoon is expected to be normal, and the El Nino effect is also expected to be absent. So these are positives for us. Taking all these factors into consideration and therefore assuming a normal monsoon, CPI inflation for the financial year 25-26 this year is projected at 4%, with Q1 at 3.6%, Q2 at 3.9%, Q3 at 3.8%, and Q4 slightly higher at 4.4%. The risks are evenly balanced. I now will be speaking on the external sector. India's services exports remained resilient in January-February of this year, driven by software, business, and transportation services. Going forward, net services and remittances receipts are expected to remain in large surplus, partly offsetting the trade deficit. The current account deficit for last year as well as this year, 25-26, are expected to remain well within the sustainable level. On the financing side, gross foreign direct investment, FDI, remained strong during the period of April 24 to January 25. Last year, which is the latest data, period for which we have the latest data, reflecting India's strong macroeconomic fundamentals. Net FDI, however, moderated sharply during this period due to higher repatriations and outward FDI. Net FPI inflows to India stood at $1.7 billion during 24-25, supported by debt inflows as the equity segment recorded net outflows. This is much lower than what we had last year. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to that last year. As on 4th April 2025, India's foreign exchange reserves stood at $676.3 billion, providing an import cover of about 11 months. Overall, India's external sector remains resilient as the key indicators stay robust. I will now be talking about the liquidity and the financial market conditions. System liquidity was in deficit in January 2025, with net injection under the liquidity adjustment facility scaling a peak of more than 3 lakh crore rupees, in fact 3.1 lakh crore rupees on 23rd January 2025. However, as a result of a slew of measures, and I'll not go into the details thereof, you are all aware of them, of the various OMOs, the CRR rate cut, the swaps that we have done. The system liquidity deficit tapered, therefore, during the last 2 months of February and March, and further it turned into a surplus on 29th March 2025. Further, coupled with the government spending picking up pace during the latter half of last month, March, the system liquidity further improved and it stood at a surplus of 1.5 lakh crore as on 7th April 2025, and even yesterday it was 1.4 lakh crore rupees of surplus. Reflecting these developments, the weighted average call rate softened and remained near the repo rate since the last policy meeting. The spreads of 3-month CP and 3-month CD rates over the 91-day Treasury bill rate have also softened since the second half of March, suggesting an improvement in liquidity conditions. I would like to mention over here again, I am reiterating this, I have said this earlier, which is that the Reserve Bank is committed to provide sufficient system liquidity. We will continue to monitor the evolving liquidity and financial market conditions and proactively take appropriate measures to ensure that there is adequate liquidity in the system. Coming to financial stability, well, I do not have much to add from my previous policy statement in February. Things are more or less looking similar. The financial soundness parameters of the banking sector continue to be robust. The liquidity buffer in the banking system is well above the regulatory threshold. Profitability indicators are also healthy, reflecting robust operational efficiency of the system. Similarly, the system level parameters of NBFCs too are very sound. Now, as has been the practice, I shall be announcing some additional measures. This time I have 6 additional measures to announce to all of you, and these relate to banking regulation, fintech, and payment systems. First, we propose to enable securitization of stressed assets through market-based mechanism. There is already a mechanism of securitization of standard assets. The same is now proposed to extend with modification to stressed assets, and I may add that this is in addition and this is not in lieu of the existing ARC route under the SARFAESI Act of 2002. Second, we have guidelines on co-lending. They are presently applicable only to arrangements between banks and NBFCs. Moreover, they are restricted to priority sector loans. To exploit the huge potential of such lending arrangements, it is proposed now to extend these to all regulated entities and to all loans, priority sector or even outside the priority sector. Third, loans against the collateral of gold jewelry and ornaments, commonly known as gold loans, are extended by regulated entities, both banks and NBFCs, for both consumption and income generation purposes, in order to harmonize guidelines across various types of regulated entities to the extent possible, keeping in view their differential risk-bearing capabilities. We shall issue comprehensive regulations on prudential norms as well as conduct-related aspects for such loans. Fourth, to harmonize the regulations governing non-fund-based facilities across regulated entities, we propose to issue comprehensive guidelines. Instructions related to partial credit enhancement by regulated entities are also proposed to be revised. This is also, if you would recall, a budget announcement relating to NABFID by the Honorable Finance Minister in her budget speech for this year. This is expected to broaden funding sources for infrastructure financing. The draft of these 4 guidelines and regulations are being published today itself for public consultation, and we shall finalize these guidelines based on the feedback received. The other two announcements relate to, first of all, enabling NPCI to decide in consultation with the banks and other stakeholders the transaction limits in UPI for person-to-merchant transactions. This limit, as you are aware today, is 2 lakh rupees. We will give the freedom to NPCI in consultation with other stakeholders to revise it as per the needs of the economy. P2P transaction limit, which is 1 lakh rupees as of now, will remain the same, and there is no change with regard to the regulations in regard to P2P or person-to-person payment transaction limits. The other and the last measure that I have to announce today is regarding the regulatory sandbox. We are making it theme neutral and on tap. At present, there are actually 4 themes on which people and businesses can work on this sandbox. Now we are making it theme neutral and on tap. Necessary directions for the implementation of these 2 measures shall be issued separately. To conclude, the global economy is going through a period of exceptional uncertainties. The difficulty to extract signal from a noisy and uncertain environment poses challenges for policy making. Nevertheless, monetary policy can play a vital anchoring role in ensuring that the economy remains on an even keel. In our context, as I mentioned earlier, the domestic growth inflation trajectory demands monetary policy to be growth supportive while being watchful on the inflation front. We are aiming for a non-inflationary growth that is built on the foundations of an improved demand and supply response and sustained macroeconomic balance. As before, we shall remain agile and decisive in our response and put in place policies that are clear, consistent, credible, and in the best interest of the economy. Thank you, Namaskar, and Jai Hind.
All right, you were watching live from Mumbai as RBI's Governor Sanjay Malhotra announced the outcome of its first policy review of the new financial year. He said the global economic outlook is fast changing, and he said that the Indian economy has made steady progress towards the goal of price stability and sustained growth. He announced RBI MPC voted unanimously for repo rate to be reduced by 25 basis points to 6% to be effective immediately. Also, the RBI MPC reduced STF rate to 5.75% and MSF rate to 6.25%. Well, the governor also said that on the inflation front, a sharper than expected decline in food prices has provided some relief, but risk from global uncertainty and weather disruptions remain. He also said that the MPC highlighted that inflation is currently below the target, largely due to the significant drop in the food prices, and there has been a notable improvement in the inflation outlook, he said, with increased confidence that inflation will align with the 4% target within the next 12 months. Also, he said that MPC is considering only 2 options, status quo or rate cuts, and saying RBI MPC decided to change stance from neutral to accommodative. As per the RBI governor, slowdown in the global growth could entail in softening of commodity and crude oil prices also. And he also said that the dent on the global growth due to trade friction will impede domestic growth also. Higher tariffs shall have a negative impact on net exports. And regarding the GDP, RBI governor said that the RBI forecast GDP growth in Q1 at 6.5%, Q2 at 6.7%, Q3 at 6.6%, and Q4 at 6.3%, with risks evenly balanced. Also, RBI governor said that growth projections have been revised downwards by 20 basis points due to policy trade uncertainties. And he also mentioned that manufacturing activity is showing signs of revival and merchandise exports will be weighed down due to global uncertainties, while service exports will continue to be resilient. Also, merchandise exports will be weighed down due to global uncertainties, while services exports will continue to be resilient. FDI has been strong last year, he said, and reflecting India's strong macro fundamentals. Also, the governor said that outlook for food inflation has turned decisively positive, and the inflation projections for financial year 26 has been projected at 4% as against 4.2% forecasted in February. Also, the governor said that RBI is committed to provide enough liquidity in the system, and the financial soundness of the banking system, he said, is robust right now. RBI governor announced 6 additional measures. One, proposed to enable securitization of stressed assets. Second, guidelines on co-lending to be extended to all regulated entities on all loans. Thirdly, regulations for loans against collateral against gold. And fourthly, comprehensive guidelines on partial credit enhancement by regulated entities. And he said that RBI remains focused and agile for the economy. And for more on this, we have Shama Mishra joining us from Mumbai. Well, Shama, how does the monetary policy announcement right now align with the growth projections, especially in the context of the new US tariffs?
Well, Lepakshi, for starters, it was on expected lines, and a large part of the market, a large part of the industry was also expecting that this could be the governor's second rate cut, and it was delivered on expected lines. So now it stands at 6% because more 0.25 basis point rate cut we have seen. Apart from that, it was also expected that in the stance, the Reserve Bank of India will make a change, and now from neutral, it's been done to accommodative. Now, if you've heard the governor's statement, Lepakshi, you know, a lot of times the governor has used the word uncertainties, and throughout the statement, we have got a sense that the Trump tariffs, the US tariffs, has really impacted the entire world, and the ripples of these effects would definitely come towards India, and this particular mention has been done in the governor's statement as well. However, he has been, you know, time and again, he has been emphasizing in his speech that the services export sector of India is robust, and also the external macroeconomic, India's macroeconomic economics are also robust. So there's a silver lining over there. Also, the inflation which has remained in RBI's biggest headache is also in the comfortable range, and also now that they are assuming a normal monsoon which will be, you know, coming from June, starting from June onwards, late June onwards, assuming a normal monsoon, it is expected that the inflation will be under the comfortable range of RBI, and the projection over there has been done at 4% for the year FY25-26, and throughout the year for Q1, Q2, Q3, Q4, it's in the 3.6, 3.9%, but for the Q4, it's 4.4%, so that is slightly higher. So going forward, we can expect that the inflation is, is assumed to rise according to RBI. Also, on the growth projection, RBI has mentioned that a 6.5%, 6.7% increase or GDP rate would be projected for FY25-26. So that's there. India is set to grow from about 6.5%. All these factors over here, Lepakshi, will have to, keep in consideration how the exports are panning, because this particular Trump tariff issue is going to be a headache, and like other countries are saying that they will be retaliating, and we've had an example of China, how China has put another one of their higher tariffs on US. This could, lead to trade wars, and that is what the fear is of the markets world over. One thing that the markets don't like is uncertainty, and it is exactly what is the world facing right now. And even if you see our Indian markets, yesterday it was trading in green, but today again it's trading in red. Again, it's gone down.
Right.
So both Sensex and Nifty 50 is down by 0.50 points. So it's like a 0.5% down, and we can expect that this particular trend would remain to do so, because we were expecting that after the RBI's decision there would be a positive impact on the markets, but it has not happened so far. So yes, it's a wait and watch situation for the markets, but yes, people on EMIs are actually welcoming this decision.
Of course, the market situation quite volatile right now. Shama, thank you so much for all those updates. And time now for a short break. We'll be back in a while. Welcome back. You're watching DD India News. I'm Lepakshi Kuran, and moving on, Trump's reciprocal tariffs against all U.S. trading partners comes into effect on Wednesday. This comes after the 10% levy Trump ordered on nearly all of America's trading partners last week. Among his sweeping new trade moves is a hefty 104% tariff rate on China. This comes on top of Chinese tariffs that were in place prior to Trump's second term. China sees tariffs increase by 34% on Wednesday as part of Trump's reciprocal tariffs package. But the president tacked on another 50% after Beijing didn't back off on its promise to impose 34% retaliatory tariffs on U.S. goods by noon on Tuesday, adding an additional 84% in duties.
Additional tariffs on Chinese goods are in place effective midnight tonight at 104%. Until they make a deal with us, that's what it's going to be. I think they'll make a deal at some point. China will, they want to make a deal. They really do. They want to make a deal. They just don't know how to get it started because they're proud people.
Well, Trump defended his trade policies, claiming the U.S. is now pouring in billions from tariffs on foreign imports. He stated that tariffs are generating up to $2 billion a day. The U.S. president has claimed the tariffs will prompt countries to try to negotiate a deal with the U.S.
Taking in almost $2 billion a day in tariffs. $2 billion a day. And we're doing very well. And we're doing very well in making, I call them tailored deals, not off the rack. These are tailored, highly tailored deals. Right now, Japan is flying here to make a deal. South Korea is flying here to make a deal, and others are flying here.
Well, on the other hand, U.S. stocks dropped on Tuesday for a fourth straight trading day since Trump's tariff announcement last week. The S&P 500 tumbled into the red in the early afternoon, with losses accelerating in the final 90 minutes of trading. The broad-based index finished down 1.6% at 4,982.77, its first close below 5,000 points in nearly a year. Stocks have been in free fall since Trump's Liberation Day event announcing tariffs on major U.S. trading partners last Wednesday. S&P 500 companies have lost $5.8 trillion in stock market value, the deepest four-day loss since the benchmark was created in the 1950s. Trump's sweeping tariffs have raised fears of recession and upended a global trading order that has been in place for decades. Also, the Asian markets opened lower this morning as investor risk appetite weakened due to the White House moving forward broad tariffs on trading partners. Japan's Nikkei tumbled 3.5% after rallying 6% on Wednesday on hopes that Tokyo may get some trade deal with the U.S. Taiwanese stocks also fell 1.7%, even though the government activated a $15 billion stabilization fund. South Korea's currency, meanwhile, fell to its lowest level against the dollar since 2009, while oil prices slumped 3% in early Asian trade. South Korean Industry Minister Ahn will soon visit the U.S., saying free trade deal with them should be maintained. And South Korea on Wednesday announced emergency support measures for its auto sector, seeking to reduce the blow of Trump's tariffs on automobile industry. Well, South Korea unveiled a package of emergency funding worth $2 billion for the auto sector hit by the U.S. tariff. The government will lower taxes on automobile purchases to 3.5% from the current 5% until June 2025 and raise electric vehicle subsidies to 30% to 80% of price discounts from the current 20 to 40%, with the period extended by 6 months to the end of this year. Well, the 25% levy on all auto imports into the U.S. took effect last week, and the new duties are expected to have a significant impact on the industry. And U.S. President Donald Trump on Tuesday said the U.S. will soon announce a major tariff on pharmaceutical imports. Speaking to an event at the National Republican Congressional Committee, Trump said the tariff will incentivize drug companies to move their operations to the U.S.
So we're going to be announcing very shortly a major tariff on pharmaceuticals. And when they hear that, they will leave China, they will leave other places because they have to sell. Most of their product is sold here.
Well, U.S. President Donald Trump has signed an executive order to boost the U.S. coal industry, including by loosening environmental regulations and opening federal lands for mining. The orders include efforts to save coal plants that were likely to be retired, including unlocking authorities in the 1950 Defense Production Act to boost coal production. They also directed Energy Secretary Chris Wright to determine whether coal used in steel production is a critical mineral. In addition, the orders direct Interior Secretary Doug Burgum to acknowledge the end of a moratorium that paused new coal leasing, which allows private companies to buy the right to extract coal on federal lands and to prioritize the leasing.
Under this order, I'm also directing Secretary Wright to use billions of dollars in federal funding to invest in the next generation of coal technology, which is an amazing technology in terms of getting the full potential of coal and also doing it in a very clean, environmental way. In addition, I'm instructing the Department of Justice to identify and fight every single unconstitutional state or local regulation that's putting our coal miners out of business.
Well, in the Dominican Republic's capital, Santo Domingo, nearly 98 people have been killed and more than 150 injured after a roof collapsed at a nightclub. A provincial governor and former Major League Baseball pitcher, Octavio Dotel, were among the victims. Dotel died on the way to hospital after being pulled from the debris. Also among the victims was Nelsie Cruz, the governor of the northern Monte Cristi province. The incident happened in the early hours of Tuesday at a concert by popular Dominican singer Rabi Perez, who was among those killed. The event was attended by politicians, athletes and other prominent figures. Hundreds of people were inside the venue and some 400 rescuers are still searching for survivors. Dominican President Luis Abinadar and his wife Raquel Arbaje visited the scene of the nightclub. They greeted authorities and embraced family members waiting for news of their relatives and expressed condolences to the families affected. And now let's take a look at other stories making news around the world. At least 50 hippos and other large animals have been killed by anthrax poisoning in Africa's oldest national park. Photos shared by the Virunga National Park in the Democratic Republic of Congo show the motionless animals floating along the Ishasa River. The exact cause of the poisoning is unknown, but tests have confirmed the presence of anthrax. Brazilian designers unveiled their latest collections at Sao Paulo's Fashion Week on Tuesday. The collection prominently features materials from the northern state of Pará, including jute. The 30th edition of Sao Paulo's Fashion Week is scheduled to run from April 7th to April 10th. A British woman became a mother after receiving a womb transplant from a sister. This is the first case of birth through transplanted womb in the UK. The operation took a team of over 30 medics and around 17 hours to complete. The woman was born with a rare condition that causes womb to be missing or underdeveloped. Hank Rogers, the man who introduced Tetris to the world, shares his journey in his new book, The Perfect Game, Tetris from Russia with Love. His story was also featured in the 2023 Apple TV film Tetris. All proceeds from the sale of the book will go to his foundation, Blue Planet Alliance. And still to come on DD India News Hour. Finance Minister Nirmala Sitharaman attends the India-UK Investor Roundtable discussion. A new Aadhaar app for secure digital verification and QR-based data sharing unveiled. Stay with us as we get you the details. Also, stay with us as we tell you how Wavix provides a stellar opportunity to the startups in areas of gaming, animation, extended reality, generative AI, among others.
Geopolitics and trade deals. Economic challenges amid development. Hard work and the path to prosperity. It's the economy always. Between walkers, money is what money does and says supply creates its own demand between the bulls pulls and bears tears. When supply chains globalization and India rises to the podium. We'll get you centered with the economic brief at 8 p.m. every Thursday on DD India.
Welcome back. You're watching DD India News. I'm Lipakshi Kurana. Moving on, President Draupadi Murmu is visiting Slovakia from today on the second leg of a two-nation visit. This is first visit by the President of India to Slovakia in 29 years. President Murmu will hold bilateral meetings with the Slovak counterpart, Peter Pellegrini, and Prime Minister Robert Fico. President Murmu will also meet the Speaker of the National Council of the Slovak Republic, Richard Resi. The state visit by President reflects the importance India attaches to its bilateral relations with Slovakia. It will provide an opportunity to further strengthen and broaden our bilateral ties. President Murmu will also interact with members of the Indian community. And our correspondent also spoke to CEO of Perfios Software Solutions, Sabyasachi Goswami, who assured that India's fintech products will find market in Slovakia.
IT has always been India's forte, and pioneering fintech has been the strongest point in recent decades for India. We have with us Sabyasachi Goswami, CEO of Perfios Software Solutions. How do you feel our potential to market ourselves for our IT products in Slovakia?
So I think this is an entry point to Europe for many, many tech-fin and fintech companies coming out of India. So world over, what Indian is known for technology is more through services. The transformation that Indian companies today are doing is more becoming a product-led companies. Coming to technology, I think the problems that we solve in India or have already solved, whether be it payments, whether be it UPI through payments, whether it's on the credit and lending side, whether it's really making financial products available to the rural and the urban population of our country, I think large part of Slovakia also needs that kind of transformation. Large part of financial ecosystem can be transformed truly by the fintech ecosystem, what we have done in India and can be brought here.
We are almost starting from almost zero right now.
Yes.
And we will be exploring further opportunities, and things are brighter for us.
We have solved payments, we have solved credit, we have solved investments, we have solved alternate data and different kind of AI which has been spoken of late by different ministries, including Niti Aayog, that we need to create AI models in-house for the country. What I see in years to come, probably sooner than what we anticipate, many of the technology firms will find their place in Slovakia and through the SARIO, which is the body here, which is helping us, and through FICCI and different association, bringing us the delegation here to explore the potential.
That's an air of optimism for India-Slovak business relation, and IT and fintech will be playing a very key role in this.
Well, earlier, President Draupadi Murmu on her state visit to Portugal interacted with various members of the Indian diaspora. Indian diaspora have found unique ways to use cork trees for entrepreneurship. As cork trees are found extensively in Portugal, it is used for wine bottles. Today, cork has many uses as bags, postcards, frames, flooring, wallpaper, and much more.
Main product is in cork. So it's made by cork tree. We have many varieties in bags and backpacks. It's from the cork tree. You can cut every 9 years, and the tree will be normal after 9 years. So every 9 years you can recut. It's very famous in Portugal. So in Alentejo there is big farms of cork tree.
Cork, which was previously used for bottles, is now being put to other uses. Nelcork in Lisbon is a shop that is using cork to make flooring, wallpaper, bags, backpacks, and multiple other products. This just goes on to show the utility of this product, which comes from this tree. The cork tree, which is grown in Portugal extensively, is cut every 9 years. We've given you an understanding of the various things that can be done with it. With camera person Loknath for DD India from Lisbon, this is Jayanti Jha.
Well, India's Finance and Corporate Affairs Minister Nirmala Sitharaman today delivered the keynote address at the India-UK Investor Roundtable discussion in London. In her address, Sitharaman outlined priorities of the Government of India for enabling sustained economic growth and investment opportunities with the policy support that is shaping New India. She added that India offers a compelling growth opportunity for foreign banks and the Government of India is actively encouraging foreign investment in the banking sector. The Union Finance Minister said that India is home to leading fintech ecosystem driven by a large tech-savvy population, supportive government policies and innovative startup ecosystem. Around 60 UK investors attending the event spoke about their keen interest and commitment for a deeper and broad-based investment collaboration between UK and India. And heads of various investment management companies termed the India-UK Investor Roundtable meeting as very productive and satisfying, saying some of the issues raised were discussed in granular detail. They added that there is a lot of optimism in India's strong economic growth trajectory that is being prudently managed.
After following the Honourable Finance Minister through all of the policy changes that she's made, it was a thrill to actually be here and to talk and listen to what she had to say about the state of the economy. I was particularly impressed at her willingness to take so many questions and to have her staff address, and herself in detail, how she'll follow up on some of the issues. It was really quite refreshing with such a large group to be able to get into that level of granular detail.
Well, it's been wonderful to be here at the UK and India Investor Roundtable with the Right Honourable Ministry of Finance. It's been a really dynamic dialogue, actually, very positive. Obviously, a huge amount going on in the world today with the tariff backdrop, but a huge level of optimism. Obviously, India's been on a really strong growth trajectory, but prudently managed, and it's all about building confidence in the future in a changing world. So overall, yeah, just really good exchange, lots of good questions, a few pointed questions on bureaucracy and how things can smoothen further the progress been made, but also hopes and aspirations for the future.
Meanwhile, today Sitharaman will attend the 13th India-UK Economic and Financial Dialogue, or EFD, with her counterpart UK Chancellor Michelle Reeve. The key priorities of the 13th EFD dialogue for Indian side includes cooperation in IFSC, gift city investment, insurance and pension sectors, fintech and digital economy, and mobilizing affordable and sustainable climate finance. Well, the Finance Minister and the Chancellor of the Exchequer are also set to announce and launch various reports and new initiatives for further collaborations. And on Tuesday, Sitharaman also made the remarks during a moderated discussion on India's development trajectory with LSE Professor Nicholas Stern at the Indian High Commission in London. She said that over the past decade, India has surged ahead, climbing from being the 10th largest economy to the 5th largest in just 5 years. Sitharaman added that this information is a testament to our prudent macroeconomic policies, reforms and the resilience of our people.
As we aspire to become a Vikasit Bharat by 2047, that is, a developed nation by the centenary of our independence, the path ahead demands innovation, sustained investment, continued reforms, and a firm commitment to inclusive growth. Our growth trajectory remains strong, underpinned by sound macroeconomic fundamentals and structural reforms implemented over the last decade.
All right, that's all for this edition of DD India News Hour, but let us know your thoughts on the news of the day. For those on the go, you can get all the latest news and updates from India and across the world on the DD India mobile app. The app is available on both Android and iOS platforms. Scan the QR code on the screen to download now. Well, we'll be back with more news as it breaks here on DD India. I'm Vipakshi Khurana from all of us here in Delhi. Thanks for watching DD India News Hour.